Good afternoon, everyone. Thanks for being here with us this afternoon. We have Jeff Carbone and Cliff Hodge of Cornerstone Wealth. They will be providing us with a market update today.
All right, good afternoon, everyone. This is Jeff Carbone of the Cornerstone Wealth team, joined by our Chief Investment Officer, Cliff Hodge, for our weekly webinar. Cliff, good afternoon.
Jeff, good to see you again. Coming in live from a rainy Huntersville today.
Yeah, it is a little dreary Wednesday out there, but happy Wednesday to all. I trust everyone is having a good week as we head into our holiday weekend. I did want to start off with a little fact today, Cliff, and I'm going to go to military time, with it being Memorial Day. So tonight at 8:20 this evening, which would in military time would be what?
2020, Jeff.
2020. What is today's date of the month?
The 20th.
The 20th, and the year is what? 2020?
That's right.
So tonight it will be 2020. So a little interesting fact, if you like that interesting.
I do. Little fun fact.
Well, Cliff, Memorial Day is upon us, and we certainly want to first remember all who have served and given their life to our country. So thank you again for all those that have served, that have given their life, and all those family members. The start of summer, which typically begins with barbecues, parties, vacations, etc., is certainly going to be a little different this year as we continue to socially distance and look to remain healthy and safe throughout the summertime. By Monday, all 50 states will have reopened in some capacity or phase. So on Memorial Day, we will basically be, again, all 50 states will have some capacity of the reopening. The markets this week certainly started off with a blast or a rocket out on Monday with markets climbing over 900 points. A lot of that built on the hopes of the positive news on the vaccine front. Markets gave back some, given that on Tuesday, results may have been a little overstated and maybe may not have been as good details that we were hoping for. But we got to realize and remember that vaccines do take some time. I think they're moving it and fast tracking as quickly as possible. So it kind of reminded me, while the Cornerstone team may not have a vaccine to keep our portfolios immune from losses, we do continue to employ the therapeutic tools such as building optimal asset allocations, active management. We're not just looking at growing portfolios in good markets, but more importantly, looking to protect against loss in bad and uncertain ones like we're in. Our process is to keep us in the know on how assets work within our portfolios and how they blend efficiently together. So Cliff, why don't we start out today with some weekly market highlights and updates.
All right, thanks, Jeff. And just want to make sure we've got the slideshow working here.
We are good.
All right. So we will hop right in with our chart. Let me get this out of the way. There we go. So this was as of yesterday. We can see that the S&P year to date is now down about 9%. Far cry from where we ultimately bottomed in March. But again, you can see just a wide array of dispersion, both again from a sector level, led higher by technology, healthcare, communications, and really everything else. Along with growth and some momentum from a value perspective. But it, again, just highlights the dispersion and again, our philosophy in our process of overweighting and underweighting certain areas of the market, really based on the economic sector or the economics regime and the growth and inflation path. So as we zoom out and look at the broader S&P 500, we closed today, at the higher end of this range. But as you can see, we have bounced really hard off the lows, but really over the past month or so, we've been in this trading range, right, between about 3,000 on the high side, 2,800 on the downside. So there has been quite a bit of volatility. As you alluded to earlier, we had the really big up day Monday, gave a good bit of that back yesterday, and then have since gone on to rally today. So it remains to be seen if we will be able to push up through this resistance, this range point. But again, as we've been highlighting on these calls, continues to be that dichotomy between what's going on in the U.S. equity markets and then really what's going on everywhere else. So when we look again at the valuation levels, don't really justify where we are. The highest level that we've been since the bursting of the dot-com bubble in 2000, 2001. So again, just this disconnect, right? This liquidity-powered market on the equity side, it just continues to be a bit confounding, right? But as we go through, I thought this week it would be good to look at a handful of sentiment indicators that we track. And so there are a variety of sentiment indicators. We prefer the ones that look at market positioning, more so than survey data. But really, we use these as contrarian signals, right? So we want to understand, what's happening in various levels of the market, but typically we want to be on the other side of these, especially at extremes. And as we'll see, there's a lot of extremes in the market now currently. So this slide here highlights small traders measured by odd lots of 10 option contracts or less, looking at their bullish positions and then netting out the bearish positions. And what we'll see here is really as of, this is data as of yesterday, now put in an all-time high for bullish options positioning for the quote-unquote retail trader, right? So we saw this last week with some of the trends in opening of accounts, on the online brokerages. Robinhood, was one that we looked at as well. So the options market certainly mirroring what we saw there from a sentiment perspective. So that's the story for the small trader. But if we look at the broader options market in general, one of my favorite sentiment indicators is what is called the PutCall Ratio. And so this particular series looks at the amounts of puts versus the amounts of calls on the equity indexes, and then really individual stocks in general as well across the CBOE. And what you'll see here is that, again, as of yesterday, we were down around 0.45 or so. This black line here corresponds to this point where we were in February, where coincidentally or not so coincidentally, the equity markets peaked out. That's what this red line here is, the S&P 500. So again, just shows quite a bit of complacency in the options market, especially as it relates to the retail trader. We also had a question last week. Last week about what are institutions doing, and I mentioned that we track positioning from the CFTC non-commercial futures. So there's a lot of information here. Essentially, what this is equity futures and options positioning for large-scale asset managers, hedge funds, mutual funds, so on and so forth, that are active in the future space. And so what we're going to want to focus on, where these green arrows are the Z-scores, right? So this is just a way to standardize positioning over a given time frame. So 1 year and 3 year, 1 year tends to be the most impactful to forward-looking returns. So that's why we focus there. And so as you can see, the way to think about this is that anything either less than a -2 or greater than a +2 begins to show extreme. So it's just a standard deviation curve, right? So, as we'll see, this is as of Friday. The data gets released once a week on Friday. It's as of the previous Tuesday. So there is a bit of a lag here. But by and large, we'll see that the institutions are net short, right? So meaning that they have a short position in the equity futures, either A, to hedge, where they may have individual longs or other types of positions, so they want to hedge those out, or B, just an outright bet that the markets are overvalued or too high and are likely to fall in the near future, right? So we're seeing this back and forth, this tug of war between the retail crowd and the institutional crowd, who both happen to be at opposite ends of the spectrum from an extreme positioning standpoint. But Jeff, you mentioned Monday. I'm glad you did, because another indicator that we track is referred to as the tick, right? So this is on the New York Stock Exchange. Just measures the number of stocks that are ticking up versus ticking down at any given instant. We set a new record for a positive tick. The tick data on Monday just shows that the significant amount of money flowing into the markets on Monday on the vaccine, the potential vaccine news. And so we point this out because given that, and given the amount of volume that flowed into the market on Monday, I'd be willing to bet that these short positions, both in the S&P, Dow, NASDAQ, from an institutional perspective, have started to come off. So again, we view those as contrarian indicators. We typically want to be taking the other side of those. We pair those up with looking at other types of sentiment indicators as well. It just shows the really that back and forth that we saw in the S&P chart. Last but not least, to wrap on the markets here, coming into the final stages for first quarter earnings. Again, this is pre-virus for the most part. 460 out of 500 S&P 500 companies reported sales up 1.2, earnings per share growth down 7. Really just the retailers are what we have left. So Walmart, Home Depot, Lowe's, we got earlier in the week, down 24% consumer discretionary, 35 for the banks versus up 10 for healthcare, 6 technology, and 6 utilities. So that's pretty much it for the market wrap at this point, Jeff.
Thanks, Cliff. And just a reminder that if you do have questions, certainly send them in and we'll answer them during Q&A in just a little bit. But also, when Cliff, when Cliff is talking about you're selling or short options or long options, short, you're believing the market is at a level that you want to lock in the price today, hoping the market goes down, and then buy it at a lower and basically make profit in between. When you're long, you're buying it today with the hope that it's going to go higher, right? So it's kind of when you talk about short positions, thinking the market has downside momentum. So again, a lot of good information on the some of those contrarian signals that Cliff has been shared with us on those slides. So market continues to move forward, and based upon again, maybe not the data. So let's go into the economic data that we're looking at, and again, just what the facts are showing us.
Yeah, and thanks for the clarification on that, Jeff. That's definitely helpful to point out. So as we go through and look at the economic data, we'll start with the New York Fed Weekly Economic Index, which again is an index of 10 weekly real-time data indicators, primarily focused on jobs. There's also some retail sales numbers from Redbook, consumer confidence from Rasmussen, so on and so forth. But as we see with the update as of yesterday, down 11.7, in relation to 2009, we have yet to see the bounce that equity markets are pricing in. Again, just showing that disconnect from the equity, U.S. equity markets and the economic picture. Also wanted to provide an update from the Atlanta Fed. So the Atlanta Fed has a resource on their website called GDP Now. Essentially what it is a nowcast of the upcoming quarter for GDP growth. So it's not an official forecast. Essentially, they look through real-time indicators. They have a mathematical model, and it flows through and spits out this GDP Now estimate. This was also updated yesterday, and the most recent forecast for quarter over quarter is down 42% for the second quarter GDP growth. We have never seen anything like that. Not even in the Depression did GDP fall by 40% in a quarter. So again, data points like this are really what give us pause. As we think about positioning and we think about getting more aggressive with both our equity and our fixed income exposure. There's even though the data has turned negative in a very short amount of time, and the equity markets believe that we have a steep fall and then a steep reversal. Just the size of the hole, I guess, is such that our view, which again is backed up by history, is that the recovery period is likely to be quite a bit more elongated than what's being priced in U.S. equities. So wanted to call that out this week as well. Quick updates on jobless claims. Again, these are released Thursday morning. We last week had about 3 million additional claims. So the tally, the total for jobless claims over the past 8 weeks is now about 36.5 million. People who have lost their jobs, which will flow through into the unemployment rate next month. The estimate for tomorrow before moving off of this is another 2.5 million. So we're trending in the right direction, but the absolute level of these numbers continues to be astounding with when you really think about the number of people who have been impacted. Continuing claims continue to move higher here, albeit at a slower rate, which again is a positive, up to about 23 million. So this again will be updated tomorrow as well. And I know we've got a Q&A session, but while we're on the topic of jobs, I know we got a question last week about how furloughed workers show up in the official unemployment figures, and I said that I would follow up on that and check back. So just want to close the loop here briefly. And what we found was that they are included in the official unemployment rate, but it depends wholly on the people who are affected reporting that to the authorities. So a lot of times, if you're furloughed and off for a period of time and have some sort of a severance, you may not self-report to the official unemployment number.
Yeah, thanks, Cliff. I think again, between the slides you showed in the market section, again, the market reaction, again, as we've seen a really nice recovery from the bottom, but as we continue to dive into the economic data, again, we have to remind and remember that this was again a swift bear market. The economic data is still continuing to come in. A lot of the information is kind of backwards looking. We're continuing to look forward and see how this market could react, and we remain in unprecedented times. So it's that more defensive approach. So let's kind of pivot to process and the positioning in our portfolios at this time, Cliff.
Yeah, absolutely, Jeff. And by and large, from a positioning standpoint, we remain defensive, both on the equity and the fixed income side. But that doesn't mean that we're not doing anything. right? We are opportunistically, buying, selling, doing some things at the margins to set us up for this new world as we do continue to traverse through the path of reopening. But going through the slides from the economic standpoint, as we'll look from the market perspective, we are remaining patient and prudent in how we make changes to our portfolios. One example that fits nicely here with the next slide is that we did add some long-term treasuries in some of the portfolios on this temporary backup in interest rates. And as we'll see here, this shows 71 on the 10-year. We're actually down to 68 as of today. So even though equity markets are rallying, again, the fixed income market, which is larger and more broad, is not confirming the move higher in equities. So this is important because within the Treasury yield are expectations for both growth and inflation over and above the risk-free rate, right? And so as yields fall, that just signals to us that the markets are really not believing in this, this reacceleration, this growth, this inflation becoming a factor to the same degree that equity markets are. So that's a big one that we continue to monitor. There's a big divergence between what we're seeing in yields and what we're seeing in equities. Similar story here with high yield spreads, right? So again, this is just the difference in interest rates between high yield bonds and their Treasury counterparts. So it's still kind of floating in between this range here. So we're range bound in the S&P, range bound in spreads between 700 and 800 basis points, which I've called out this week on the chart. We are at similar levels to where we were the last two times we had recessions, right? So as you can see, spreads were already elevated from the lows, but in both instances they continued higher as we worked our way through the recession and through the poor economic data that comes through. History doesn't always repeat itself, but often rhymes. So again, this is another data point that the fact that we're remaining elevated both on the high yield side and on the investment grade side too, right? Just again, gives us pause in getting really aggressive, even though markets are trying to levitate higher here, equity markets. Update on the US dollar. Again, this is important because really everything is priced in dollars, right? Stocks, commodities, the global economy is does business in dollars. And so while we've come off a bit from the highs here around 103, 104 on the ICE US dollar, the DXY, we're still at 99, still elevated. Again, when you look back at larger periods in history, we want to see this thing break down before we have real confidence in the global reflation trade with what the Fed and the Treasury are doing. Commodities, another one that has signaling power, right? So you saw the signs in pre-equity market sell-off from a commodity perspective and from a yield perspective. While we have bounced, we're coming up against some resistance here. We want to see this thing break back, continue higher, closer to where we were before the start and the outbreak of the virus. But one good sign, one major component of the CRB index is crude oil, right? So we had that brief period where we went negative, and we're all the way back up now to 33%, give or take. Still about 50% off the highs, but certainly moving in the right direction. This will be a big tell once we see how this settles out and some of the volatility begins to come out of the market, the oil market. Similar story for copper. Putting in higher highs. This is certainly a good sign, but again, a good bit off of where we were from the highs, right? So we want to continue to see this base and move higher along with, oil, along with yields, along with the dollar. It's never just one thing, right? It's the mosaic. This is what we mean by the market mosaic. And then lastly, the VIX, the volatility index for the equity markets. We've come down, quite a bit from the highs up near, 85, 90. We highlighted the 30 level and continue to try and test that and break down toward a more normal, 20, 15, 20 range is kind of that long run average. But, this week in addition to just looking at this is the spot, what's called the spot VIX. The VIX also has a futures curve, right? So just like commodities, just like equity markets, have futures that have prices out into the future, the VIX does as well. And what this tells us is that even though today we're 28, 29, when you look at what the market participants are forecasting really for the remainder of the year, it's north of 30 and really not peaking until the election, right, in November, around this 32 area, before beginning to tail off ever so slightly going into 2021. So again, this is another data point that corroborates what our view that we're likely going to be in it for the long haul here. There's no V-shaped recovery in the VIX. You'd see this thing really fall pretty quickly. And so again, that's just more evidence, gives us more confidence in again relying on our 3 Ps, right? Our process, the planning that you do with your advisor, the process that we have on the investment side, and again, most importantly now, is having patience, even on big up days like we had today.
Well, yeah, thanks, Cliff. And just it continues to remind, a good reminder, again, this was starting as an event-driven bear market, and with the pandemic and with COVID-19, still continue to watch the implications there. When you look at the virus, we know it will end. We know how it's going to end. We just don't know when it's going to end yet, right? We don't have the when yet, and we're continuing to work through as a country and as the world is continuing to work through the when part. What we're continuing to watch is is it morphing, and does it morph, or what does it, from a financial crisis side, we want to continue to watch and be careful, and that's why we continue to share that economic data with you. Cliff, I don't see any questions today, so we can kind of keep moving along unless there's a question that pops up while we're kind of in our recap here. But we continue to share the details on the markets, the economy, and how it, along with our strategy and the positioning of our portfolios. As Cliff mentioned, we're still not seeing the coast being clear. We're anticipating the bouts of volatility on both up and downside as we continue to work through this. Markets are not always reflecting, as I mentioned before, what we're seeing or reading on the economic front. And we've heard, I always kind of go back to Brian Needleman kind of talking about money. The markets are not meant for people to make money, because they're based on the 2 biggest emotions, and that's fear and greed. With our process and our patience, we're trying to take that emotion out and look to make decisions based upon the facts. Cliff mentioned we're remaining positioned in a more defensive manner. We're continuing to watch the signs and the signals through our process to provide more clarity for us to make those changes. We're making adjustments, but haven't made big changes at this point. We hope you continue to share and join us on our webinars each week. If you can certainly share the replays by sending those to friends, family, coworkers. If you were not able to join us yesterday, we held a webinar with John Emerson, who is a former ambassador to Germany, and he was a ton of knowledge, shared a ton of information. Definitely, I highly recommend to listen if you when we get the replay out, or when it's on our website. Certainly go to cwgadvisors.com. Remember to recommend or friend us on Facebook, join us on LinkedIn. We appreciate that you all do that. Again, as we go into Memorial Day, we have to remember all those who gave their life for our country. We are still the greatest country in the world. There is no doubt we will get through this stronger, but let's remember those who gave their lives on this Memorial Day. We hope you and your families have a healthy and safe weekend, and we will be back and talk to you next week. Thank you, everybody. Be safe.